The US dollar has swiftly regained strength, nearing 285 rupees in the interbank market after reaching its lowest point in mid-October. This surge, amounting to 7.7 rupees or 2.8% over the past 10 sessions, is attributed to dwindling inflows and robust demand from importers. Experts point to multiple factors, including the short supply of dollars and diminished hopes for foreign investments from the Middle East following Israeli attacks on Gaza. Despite positive talks with the IMF regarding the release of the second tranche under the $3 billion standby arrangement, experts remain skeptical about significant inflows. The recent wave of terrorism in the country has introduced uncertainty affecting economic stability. While exporters welcome the dollar's rise for profits, concerns loom over imported inflation impacting the manufacturing sector. The market anticipates the dollar to stabilize around 285 rupees, with occasional spikes contingent on IMF's assessment of Pakistan's economic situation. India's foreign exchange reserve surged by $2.6 billion, reaching a one-month high of $586.11 billion as of October 27, as reported by the Reserve Bank of India. This increase followed a $2.4 billion decline in the previous week. The rise is attributed to the maturity of a $5 billion rupee swap conducted by the RBI last year, resulting in a reversal of the trade. The data also reflects the impact of revaluation changes and regular spot interventions by the RBI. These reserves include India's reserve tranche position in the International Monetary Fund. Meanwhile, the Indian rupee experienced a slight decline against the US dollar, trading within the 83.0650 to 83.2550 range for the week, settling at 83.2750 on Friday. Despite hitting a record low of 83.2950 on Wednesday, the currency remained relatively flat for the week. A substantial gas tariff hike approved by the federal cabinet in Pakistan has sparked widespread concerns among industries and business leaders. The increase of up to 172% for domestic consumers, 137% for commercial consumers, and 193% for cement manufacturers, effective from November 1st, is feared to raise production costs significantly. Small and medium-sized units are at risk of closure, making exports less competitive and leaving thousands of employees unemployed. Industry representatives, including the Karachi Chamber of Commerce and Industry, have voiced their distress over the decision. They argue that the hike disproportionately burdens industries, especially in Karachi, where reliance on gas is high for export-oriented production. The move has been criticized for favoring industries exporting gas without value addition while imposing hefty tariffs on sectors that may struggle to absorb the cost increase. The situation poses a threat to the backbone of industrial production, the small and medium-sized enterprises, and raises concern about the overall economic impact of the tariff hike. US businesses are seeking certainty regarding the future of the African Growth and Opportunity Act, a key trade program granting duty-free access to the US market for qualifying African nations. With companies diversifying away from China due to supply chain challenges, Africa is becoming an attractive investment destination. AGOA, set to expire in 2025, is crucial for American businesses looking to invest in the continent. US officials held talks with African trade ministers in Johannesburg, emphasizing the importance of AGOA's reauthorization. The program allowed over $10 billion worth of African exports into the US duty-free last year. African countries are urging Congress to pass a 10-year extension without changes, while divisions in Washington persist on whether AGOA needs updates. The Biden administration aims to work with Congress to improve AGOA, highlighting its significance in countering Chinese influence in Africa.